We look at financial instruments.
Okay.
Now, financial instruments tends to be a daunting topic for students, but it shouldn't be. It's just the terminologies maybe which are not used in day-to-day language, but the financial instruments are things that we know very well. Let's break them down. Financial instruments is broken into financial assets, financial liabilities, financial assets are assets such as cash. Now, we're all familiar with cash, isn't it?
Yeah.
There are assets such as equity instruments of another entity. Now, when you say equity instruments of another entity, what do you mean? You simply mean equity, we know is shares of another entity. So you have shares in another company. A contractual right to receive cash or another financial asset from another entity. So if somebody is owing you, they're supposed to give you cash, or they're supposed to give you any other financial asset. That's a financial asset to you.
Okay.
The next is to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable. So there's going to be an exchange. You are giving out something and you are receiving something. But what you are receiving is worth much more than what you are giving out.
Okay.
That's a financial asset. Okay?
Yes.
Examples will be trade receivables, options, shares. All those are examples of financial assets. We go to a financial liability. It's any liability that is a contractual obligation to deliver cash. Okay. Now you notice the asset was what? To receive cash. The liability is to deliver cash or another financial asset to another entity. Or to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable. This time you are exchanging, but what you are receiving, what you are giving out is more than what you are receiving. Okay. Examples would be trade payables, would be debenture loans, mandatory redeemable preference shares, forward contracts standing at a loss, also under financial instruments, yes, financial assets, we have equity instruments. An equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. Now, when you have a company, when you prepare your financial statements is divided into two major components, the assets section and the liabilities. So if once you've deducted, paid off all your liabilities, you have got excess, that is an equity instrument.
Okay.
Now, we'll look at an illustration. I'll read out the illustration.
Okay.
A company issues 100,000 6% redeemable preference shares. Now, redeemable preference shares, in substance, these are debt. They are not equity.
Okay.
Okay? Why? Because they meet the definition of a financial liability.
Okay.
Clear?
Yes.
Now, because they are redeemable, let's expand on that. Redeemable shares simply means that the holder of those preference shares, if they so choose, they may redeem them into equity.
Okay.
Clear?
Yes.
So, the redeemable preference shares will be reported under non-current liabilities.
Okay.
Okay? Unless if they are redeemable within a year, then they'll be reported under current liabilities.
Okay.
So if you issue 100,000 6%, that 6% is the interest which is payable on that 100,000.
Okay.
Now in this case, because they are preference shares, it will be the dividend. So it will be 6% of 100,000, that will give you 6,000 as dividend, which you are going to report in your P&L as a finance cost.
Okay.
Clear?
Yes.
Now, a redeemable bond is also known as a compound instrument.
Okay.
What this means is that it's got two elements in it. Because it can be redeemed to shares, so it's got a component of equity, or it may not be redeemed, it's got a giving it a component of a liability.
Okay.
So at inception, these two components have to be split from the compound and identified or recognized separately in the financial statement.
Okay.
How do we do that? We determine the liability component. Which is calculated by discounting the interest payable on that compound instrument. That interest is then
Okay.
The interest is then discounted. In the final year, we discount both the principal and the interest. You total up the discounted interest plus the principal, The total gives you the liability component. Clear?
Yes.
The equity component, you get it as a balancing figure. So the compound instrument itself, you subtract what you've computed as the liability component. The residue, the remainder, is the equity component, which you are going to take to other components of equity in the financial statements. You do not take it, you do not add it to the share capital until conversion. If they do convert to shares, that's when it moves to joint share capital. Clear?